welcome to Money Control Market Weekly. I'm Karunya Rao, and as always, we're back with a brand new episode where we will be discussing the big trends playing out in the markets and helping out all you retail investors plan your journey better, plan your goals better, and hopefully achieve what you set out to do in the markets. Ahead of Independence Day, actually, we thought we'll get you somebody who will help you become financially independent, who will talk to you about your starting of your investment journey and also help you strategize better and work towards your goals in a better way. Joining me today is Srikant Bhagavat from Hexagon. Thank you so much, Mr. Bhagavat, for taking time out and talking to us.
My pleasure, Karunya. Happy to be with you.
First things first, I want to understand how are you assessing the market mood? The week gone by was truncated, but still we're looking at a firm finish for benchmark indices. Macro data largely looking mixed, if not positive. What should investors look at right now, and how should they read into the cues they're getting on macro as well as micro indicators?
So it's always the short-term noise is always confusing, right? One has to try and see the short-term indicators from the long-term indicators and stay focused on long-term. The long-term in India looks pretty good. Structurally, we're on a good growth path, and taken all the macro indicators onto the table, nothing looks dangerous. Even the one hot topic that is inflation looks fairly under control. I think over the next 2 quarters, going by what the Reserve Bank says, things should be under control and we'll be on a better path then. So for a long-term investor, the markets look fine. If one is taking tactical calls, I think we've had a good short-term rally over the last few days.
Right. So I'm sure you're flooded with questions from your clients, people around you, and even we get a lot of questions about what to do now, because markets, yes, over the recent few weeks, they have been resilient. But will this resilience continue? And amid all this uncertainty, how should you plan your investment journey?
So you said it, the uncertainties are bound to be there. Nobody has an answer to whether the conflict will end, a new one would begin. These are unknowns, clearly.
Yeah.
And asset allocation helps you go through such times. Okay. One cannot take the risk of being out of equity for any long-term investor. And the SIP route, ideally, takes you comfortably through these points of time. Okay. A few investments made at a high point of the market does not hurt. So even though you continue SIP, it's fine. So in the long term, you will hardly feel the change in returns when you look at this. And the lower risk part of your asset allocation helps you keep your portfolio less volatile. So one would be rather comfortable with the portfolio movements when you have some amount of fixed income also in your portfolio. So the SIP, great way to do it. I've done it myself. I've seen my clients do it for more than 2 decades. It has never failed.
Okay. But according to you, yes, you've talked about SIP, but overall, what is an ideal way for asset allocation? What should be the proportion like?
Yeah. So there's no ideal. The ideal is only for the person, because each of us are wired differently. Right? This is something you heard over and over again. It is like a cliche, but that is the truth. We are all wired differently, and we need to figure out for ourselves what is the risk we are comfortable with. The lay investor may not be able to do it, but sitting with an advisor, the advisor would be able to help him or her figure out what is the ideal risk quotient. Okay. One is the way we are wired. Okay. The second is the time we have to reach our goal. So when you have many years ahead of you and you are wired to take risk, everything is in sync, go ahead. Okay. But if you are wired to take risk, but your goals are short term, you have to become conservative, or you risk the not meeting your goal. So if it's a critical goal, you don't want to take that risk. If it's a non-critical goal, you may want to take that risk. Okay.
Yeah.
So how you're wired and the criticality of the goal and the time horizon, there are 3 things you should keep in mind when you're figuring out what your asset allocation should be for a particular set of investments.
Typically when you are starting your investment journey, there's always a trade-off between risk as well as returns. Now, how should retail investors or somebody who's new to the market, or the whole process of investing, how should they know whether they're taking on adequate risk or if they're entering the riskier territory? What is the way to assess? And more importantly, how should you know what is your risk? I mean, if there's a newbie investor, how can they decide what kind of a risk they're ready to take on?
All right. The first is, if you create a roadmap of what you want to do over the next few years, how much money you're going to need, without taking any risk, if you're able to achieve your goals, then so be it. You have the choice of not taking risk. Okay. But if there's a gap between what you can do without taking risk and what you need, then obviously you have to take some amount of risk. Okay. And if one, then there's a choice you have there. You either tone down your goal, or you should be willing to take a higher risk and find the balance there. Okay. This is
Yeah.
purely based on numbers, based on your goals. If you go through a psychometric risk assessment, then you'll also know whether you're suited to take a risk or not. If one panics with a shortfall in the market, obviously either one has to get better educated or should not be taking that risk at all.
Okay.
So
Makes
taking a
sense.
psychometric risk is good.
Yeah, makes sense. But if we look at only, say, an equity portfolio, is there a right way to build this? You've talked about SIP and the benefits of it, but there are other vehicles also. There are, market-linked insurance plans. There are ETFs, several other ways perhaps that one can look at. So, how should you look at equity investing and building your equity portfolio?
So anybody who wants to hedge their long-term wealth against inflation, I think has no choice but to be in equity. The proportion you can decide, whether it is 30% or 50% or 80%, is how you can decide based on all the things I've spoken to you. But if you want to beat inflation, there's no choice. You may choose to be doing it through active funds or ETFs or through a ULIP, but be in equity. No doubt about that. The risk is not to be in equity, if you ask me. Then how are you going to create wealth? Fixed income is like a treadmill. You are walking, or running, but you're not going anywhere. You're in the same place. If you want to move ahead, you need something that beats inflation. And traditionally, it's only been equity or real estate that beats inflation.
What about investing in, since we're talking about diversification, what about investing in gold? Now there's silver ETFs as well in the market, and typically a lot of people end up buying just physical forms of gold. Given the uncertainties, given lingering fears of recession, is it a good time to invest in gold? Because gold also saw a fair amount of consolidation, but yeah, it has bounced back once again. But most commodity analysts say that it's a good time to look at precious metals.
Correct. Whenever there's chaos in the world, it's a good time to own gold because it's the asset of the last resort. It is liquid and it is said to be preserving value. Okay. So you can go and liquidate it at any point of time if it's physical gold. And today, of course, you have options with ETFs and gold index funds, which fetch you the same amount of liquidity, maybe even better than physical gold. But gold should be only seen as a hedge from the pure portfolio point of view. If all else fails, then the gold will support me. So we have been recommending around a 5% exposure to gold over the last 24 to 30 months. Earlier to that, I don't think we had any gold, unless it was a personal preference by the investor. So as we go through these inflection points, there's so many changes in monetary policy globally. Inflation has hit us. Interest rates are changing. So at such times, it would be safer to have a little bit of gold. Okay. And
but how
the way
do
you
you?
should
Yeah,
is
go on, go on.
if your gold is not doing well, then you should be happy because then the rest of the portfolio is doing well.
Yeah, yeah.
which is the bulk of it.
Yeah, but interestingly, earlier this year when the Russia-Ukraine conflict had just broken out, we saw all asset classes falling, which we typically don't see. Like you just said, when gold is falling, typically other asset classes, especially equity markets, tend to do well. But at a time like this, when there's geopolitical tension, there is supply chain issues, there is inflation looming large, and perhaps various asset classes are witnessing a selling at the same time. What should you do? Because new investors typically tend to panic. They're seeing something like this for the first time ever.
Yeah. So last year we saw this happening, right? All
Yeah.
asset classes lost value globally, and the only one that gained value was energy. Crude oil was the only one that gained. Generally, we would say that fixed income, equity, gold, all three would be non-correlated, and hence it's a good idea to have all the three. But at times, these correlations break down, like last year. And why did they break down? One has to not take it blindly, but look at all the things that are changing. We've had geopolitical uncertainty, which should generally say go for gold. Okay. But then we also at the same time we had severe inflation in the US and change in interest rates, which strengthened the dollar. In which case, people prefer the dollar to the gold, and
Hmm.
people investments just moved to the US dollar, not giving preference to gold. So gold did not do well. It was only the dollar that did well in the last few months. Equity is only recovering
Yeah.
now, but over the last few months, equity did not do well, bonds did not do well, gold did not do well, only dollar did well.
Yeah.
So one has to keep tabs about with what is happening in the immediate environment and what are the factors that are causing change, and tracking where risk is and where risk is not perceived to be there. Okay.
And
So
when markets, yeah, go on.
even now, if you're going to extrapolate the strength of the dollar, you could still go wrong.
Yeah.
It happened
Yeah.
for a while. So the danger is an extrapolation.
And when the markets did start recovering, when commodities and even gold, etc., started showing some bounce back, the big question that at least we received a lot from our viewers was, should I exit and should I book my profit and leave? Because many of them are new investors, and many of them probably think that again there will be a dip, again there will be phases of correction, and perhaps they don't want to deal with it. So what would be your advice to such people? Because after a long time, we're witnessing a good, sustained recovery in the market, and people want to exit.
I would say do not exit, because if you do exit, you will never know when to enter back. So it's very easy to say theoretically sell at the top and come back at the bottom, but neither can you find out the top, neither can you find out the bottom. You take a dipstick survey and you'll find out how many people have been able to figure out the bottom. Having seen and tracked markets for more than 2 decades, it's been very difficult to track out a bottom. But
Yeah.
fundamentally, you can figure out whether a market is overvalued or undervalued. Okay.
Hmm.
So you could, as a tactical position, have more equity or less equity based on this, but never zero or never 100.
Hmm.
So what happens is, this is where asset allocation comes in use. If you have a reference point, say 50-50, okay, and you think that markets are undervalued, so you can increase your equity position based on your 50. Instead of 50, you can go to 55 or you can go to 60 and go overweight.
Hmm.
Or if
Yeah.
you think that markets are overvalued, with reference to the same 50, you can come down to 45 or 40 based on the extent of overvaluation. But if you take the risk of completely getting out of equity, and there is some factor that you missed out which is causing the bull run.
Yeah.
We don't know what's happening for sure all around the world. Okay? So if the Ukraine conflict stops tomorrow, the market would continue to rally on, and you would have
Yeah.
lost it. Okay, it could possibly be the first leg of a structural bull market for the next few years. So never take the risk of taking drastic actions, whether it is a new
Hmm.
investor or an experienced investor. For a new investor, I think they should just go on and not get out of the market. Get your asset allocation straight, get your time horizon straight, and not try to time the market. For an experienced
Okay.
investor, one can take tactical positions. Again, never take the risk of 0 or 100.
You were just talking about finding the bottom of the market and stock picking when you exit and when you want to perhaps make a comeback. But if you see where the market is right now, after all of the consolidation and volatility, do you think markets are fairly valued? Are you comfortable with what's available at the current price?
Looking at the consensus forward estimates for, say, the top 50 or 100 companies, it looks like we are at a neutral level. Maybe we are fairly or slightly above fair valuation at these market levels. So to take on new positions, one has to be very careful, maybe not take it on a market level, but unless you're able to figure out a particular sector that you like a lot and still has way to go, you could do that. But otherwise, we are not at fair valuation. We are slightly above fair valuation today.
Okay. So, are you advising people to not make any fresh equity investments right now because it still looks slightly overvalued?
So SIPs, as I said, we will not stop.
Hmm.
That has to continue. And if there's fresh money coming into a portfolio, we'll stagger it out. Okay, we'll stagger it out on the conservative side because I think as compared to a month ago, we are not in the same valuations.
Yeah.
So money coming in today, I'll be a little more careful about it and spread it out. But again, not stop it completely.
Overall, what's your assessment of the inflationary pressures from here on? Because it will have an impact across asset classes.
Yeah. So we have already seen the Q1 results coming in, and margins have been compressed, and largely because of inflationary pressures. Most companies have had to take the hit of increased input prices. Very few companies have the strength to pass on the cost increase to the consumer. Okay.
Yeah.
Those who have that wonderful brand equity can pass on the cost, and that's why they called great companies to own, the high quality companies. We are going to see this pressure on for at least another quarter, I think, Karandya, before we see some kind of a relief.
No, we've spoken about equity investing, but let's talk about debt. Let's talk about passive funds as well. Do you think that is also a pocket where investors can look at right now, or should they stay away? Because debt clearly seems to not be a favorite at this juncture with the interest rate scenario.
Yeah. The entire last year was not great time for debt. People hardly got 2 or 3%. If they were lucky, otherwise maybe 4.5%. And liquid was the safest place to be in entire last year. But things have changed. We are somewhere coming to the end of the interest rate cycle, end in the sense the rising rate cycle, maybe another few basis points up, correct? So the long-term yields are looking pretty juicy now at 7% plus. And I would say it is time to start taking exposure to long-term gilts. There's not much of a difference between a gilt and a corporate bond, AAA corporate bond. So my preference is to Government of India securities. So you've seen the yield curve. The short term is at 5.5% now, and the medium term is at around 7%, and the long term remains also around 7.2, 7.3%.
Yeah.
It had moved up to 7.6 and then corrected as the pessimism went away. So it is difficult to get 7% plus yields for the long term. To me, it looks attractive. The short-term volatility, swallow it and get into long-term bonds. The Government of India sector.
Makes sense. But today investors want to invest beyond debt and equity, and there are a lot of options available in the market. So for those new age investors, what do you suggest they can invest in and they can consider as an investment option aside from debt and equity?
As alternatives and apart from debt and equity, one type of investments which we have been finding attractive and including in our portfolios are real estate investment trusts and infrastructure investment trusts. Both REITs and InvITs, we have been including in portfolios, and we have carved it out of the fixed income portfolio. Instead of exposing to debt mutual funds, we are exposing a reasonable sum to these set of investments. Because at one point of time, the yields here were much higher than bond yields. The entire last 12 to 18 months, we did very well. And for those wanting that quarterly income also, it's good. The yields are pretty good. And especially in the time when inflation is kicking in, you want a real asset backing. And a real estate investment trust has a real asset backing. Even an infrastructure trust has a real asset backing, which we found attractive. And that played out. It worked well over the last 2 years for our clients. So apart from
Right.
REITs and index, you did mention passives. Okay, so passives are, you find them both in equity and debt. Correct? So whenever you think you do not want to have the subjectivity of the investor or the fund manager, a passive is a great one.
Yeah.
The tribe of passive investors is only increasing in India. Correct?
Right.
So we find
So,
that
yeah, go on, please.
we find that the large cap equity space is very vulnerable, and that is where an easy substitution can take place for a passive fund. Okay, you can straight away get into an index fund, the Nifty 50, the Nifty 100, or you have a number of thematic and strategic ETFs, which are also attractive for somebody who wants to take a call on the market movement and market direction. So there are exciting options there in the strategic ETF spaces. Okay.
Yeah, there are, in fact, and thanks for flagging them off. I'm sure a lot of our new and young investors will take note and make use of these investment avenues. But before we let you go, I want to understand, typically we talk about getting financially independent very much ahead of Independence Day. So, what does financial freedom mean to you? And what do you teach your kids and young people around you when it comes to becoming independent at an early age financially?
The first thing about financial independence is ability to take your decisions without any strings attached. Okay, any life decision should be able to take. You should be able to take. Okay, planning helps. If you plan in advance for all the known life decisions and the life goals, you're free of pressure. You're going to sleep well at night. You're going to take the right career decisions when it comes to that. Okay, you may not want to sacrifice job satisfaction for a better package if you've got your planning in place. Okay, so these are critical for any youngster or anybody who's in their midlife. So financial independence means ability to do what you want without coming under stress.
Okay, well, that's very aptly and very simply put. Mr. Bhagavat, great chatting with you, and thank you so much for joining us on Money Control today. And I hope our viewers are taking away lots from today's conversation, how important it is to diversify your portfolio and how you can go about allocating your assets within your portfolio, within your means and your goals. Thank you so much for taking time out. And thank you guys for tuning in.
You're welcome. My pleasure.